So again, welcome everyone to the Alliance of Angels. We are doing a webinar today about the ERTC funding tax credit. AOAC is at the center of startup funding in our region. We're the largest angel group in the Pacific Northwest, over 150 members. Members such as myself, Glenn Gatis. I've been a member for about 3 years. And we also have family office members, local VCs, the #1 funder of female-led startups in the Pacific Northwest. And that's definitely true. The last meeting we had 4 presenters and 2 of them were female founders. So always excellent to see. We invest in a large number of deals per year, over 20. Seems like probably a higher number than that, over 10 million invested. We also have the Innovation Fund, which allows a diversified approach to members who contribute to that to invest in over 10 companies or up to 10 companies with a single investment. And 50% of companies investing at or presenting at AOA get funded on average. And average deals are between 250 to 500K per investment. So I'm going to hand it over to Thomas with ERTC filing, and he's going to present. And he just asked for questions, if possible, at the end of the presentation, or you can send them in the chat. And also I wanted to remind everyone to stay muted as well during the meeting so we don't have any erroneous audio. So I'm going to go ahead and hand it over to you, Thomas. Let me stop sharing and I'll give you control of the screen.
Great. Thank you very much. It's nice to be here today. Share my screen here. Okay, hopefully we're seeing this. As he mentioned, Tom Savageau, ERTC filing. We're a local company based here out of Enumclaw, Washington. We started up with ERTC filings about 2.5 years ago now, when this program really first started gaining a little momentum. Didn't happen until some of the rules changed, as we'll go over here today. But my background, just so you guys have a little more history as far as where I came from, I owned a regional accounting firm over out of Central Washington that had offices in Wenatchee, Leavenworth, Chelan, and that office I sold about 7 years ago and had been doing outsourced CFO work for multiple businesses around the area, and particularly focusing on acquisitions, mergers, and helping businesses work their way through that, and really especially the small business owners, really being able to help business owners that might not have the wherewithal from a business standpoint to understand how an acquisition goes, or even the financing, usually SBA financing for these acquisitions. So helping out with that was really my specialty. When COVID hit, obviously there was a lot of disruption in business, and a lot of businesses reaching out to people like me that needed help navigating not just the rules that were out there, but also, how to stay financially viable through COVID. And of course, when the employee retention tax credit came, I just found myself particularly situated to where my expertise in the back with the accounting background, understanding complicated tax matters, and then understanding how to apply those complicated tax matters to make things easy for businesses to take advantage of, and the huge need for businesses to jump on taking advantage of this that could, and not having a solution out there. And that's where ERTC filing came from, was providing a solution for this. So hopefully a lot of you have heard about the employee retention tax credit by now. A lot of what I do is education on industry trends, especially a lot of misinformation that's out there. There's just a ton of misinformation. And so most of what I do is I speak nationally in person on webinars about this topic, and basically just trying to bring education to the industry, especially to the accounting industry. There's a lot of CPAs and accountants that have done some research on this and gotten information, but I find that their information isn't up to date because of all the changes that happened with this program as it evolved. So what we're going to do, we're going to start from the basics. We're going to go over some basic information about who qualifies, how much you qualify for, but then I'm going to kind of proceed into a little bit more of what I'm seeing in industry trends, some pitfalls to be aware of. The IRS is sending out warnings because there's a lot of companies that are doing this very poor service to their clients by doing this incorrectly and involved with price gouging and charging clients at considerably way too much for these services. And unfortunately, business owners just aren't aware that that is not an option that they have to take, and that there is a right way to do this and a wrong way to do this. And that's what the IRS is trying to get the information out. So we'll talk about that a little bit. And then, as Glenn said, at the end here, I always like to leave it open for a Q&A session, but that helps out with making sure to keep it customized to your guys' industry, and whatever questions you guys have, if you can post them in the chat or save them to the end, would love to go over that. So maybe Glenn, give me a heads up if you can see my screen. I just want to make sure. Okay, great. Okay, so let's go over some of the basics here for ERTC and what it is. Employee Retention Tax Credit, you'll hear it intermingled with ERC, Employee Retention Credit. It's the same thing, so that's just two different ways of referring to it. Really, it was created when the CARES Act came out in March of 2020. However, when it came out, businesses could only take PPP or ERTC, could not take both. You were automatically ineligible for ERTC if you got a PPP loan, which most of us did because so many banks were pushing for the loan. It was done through SBA, so it was handled in a very streamlined fashion. So most of us were very aware initially of what PPP was and not very aware of what ERTC is. It wasn't until December of 2020 that the rules changed and ERTC became something that you could take with PPP if you went out and got a PPP loan, or if you didn't. So basically a PPP did not make you ineligible to file for the ERTC. That was a huge change. And that was brought around by Congress because it was realized PPP was meant to cover 2.5 months of payroll. Well, that was March of 2020. By December of 2020, when the Consolidated Appropriations Act changed the rules, that's when Congress realized that, hey, 2.5 months of payroll reimbursement for businesses isn't enough. We need to do something else. So the ERTC, which was already in existence, they decided to make businesses eligible to claim both, as long as you're calculating it correctly, not using wages you're calculating for ERTC in what you calculated for PPP. And again, we'll talk about that here in a sec. So once this changed, that really opened up this program to a lot of eligible businesses out there. And we'll talk about eligibility and how a business is eligible so that you guys understand whether a business is eligible. Not every business is going to be eligible, but a lot of you are. And I would definitely say if your CPA or accountant has told you you're not eligible because of something like you didn't have a loss of revenue, that is inaccurate. You really should be doing some research on this because there are multiple ways to qualify for this program. So make sure that you've gone through and taken a look to see what it is. So again, ERTC can be taken even if you've got a PPP that doesn't make you ineligible to claim this. It was extended quite a bit and again, changed quite a bit. So I already told you about the CARES Act, the Consolidated Appropriations Act, then the American Rescue Plan Act actually changed it. So 3 different times this program had changed. And then beyond there, we had different rules and rulings that the IRS gave us that actually changed our interpretation of what this program was. There was a lot of evolving that this program went through as it went along. And that's where some of this misinformation came from. It was meant to be a help for small businesses that paid payroll in 2020. With the Consolidated Appropriations Act at the end of 2020, it also expanded into 2021. For some businesses, it could go all the way to the end of 2021, and that period in 2020 and 2021 is a big period of potential payroll reimbursement, payroll you've already paid that you could be eligible to be getting back from the IRS. So this is kind of a big thing that I like to hit on a little bit is that a lot of businesses that started after February 15th of 2020 weren't eligible for the PPP. I had a wine bar I just happened to purchase on February 15th of 2020, right before COVID hit. We were not eligible for PPP, but we were eligible for ERTC because there's actually a portion of this that works with businesses that started after February 15, 2020, that automatically qualifies them for some reimbursement of payroll at the end of 2021 called recovery startup businesses. And we'll talk about that here in a little bit. So what is the ERTC? How does it work? What am I talking about? It's a credit on the payroll the employees pay, not just the taxes. So I get some people that get confused when they hear employee retention tax credit. They think it's on the payroll tax that you're paying. It's an actual reimbursement of the payroll that you have already paid. It's processed through the IRS. So you have to file IRS forms. It's usually a 941X that you're having to file in order to claim what this rebate's going to be. It is not something that that you're going to have to worry about paying back or asking for forgiveness. It's already based on what you've already paid. So it's a tax credit that's coming off of there. I often hear, hey, it's just a tax credit, so it's offsetting tax liability. No, that's not true. It's not just offsetting tax liability. It's a refundable tax credit, which means it's an actual check that you get from the IRS after you file this. It's mailed to whatever address is on your 941X. That's a business payroll tax credit, not a personal or income tax credit. That's an important factor because, quite frankly, a lot of times CPAs and income tax preparers, their industry that they specialize in is the income tax world. This is not an income tax credit. This is a payroll tax credit. Oftentimes, a lot of small business owners have bookkeepers that are filing their payroll tax forms. And that was actually one of the reasons why there weren't a lot of providers out there that knew how to do this accurately. CPAs were not typically filing your 941 for you. Bookkeepers who were filing your 941 for you weren't typically able to get into complicated tax matters. So there weren't a lot of availability for people that understood this program or how to actually file for that, which is one of the reasons why we ended up creating this company to help people file for this. As mentioned before, this is not a grant or loan. You can do what you want with the funds after you receive the funds. A very important thing that is talked about here later, unlike the PPP, it is taxable. So when you get these funds, what's basically happening is that it's reducing the amount of your payroll expense, and you do need to report that as part of your reduction of your payroll expense on your income taxes for the business. I definitely make sure that people understand that. It's on all of our forms and our instructions when we send it out. This is one thing the IRS is warning business owners about, are companies that are filing this for them and not educating them on making sure that they understand this does impact income taxes. But I would give this example. Yes, it is taxable. Because it's taxable, I get the question, well, maybe I shouldn't file. What if it created too much in tax liability? I try to give the example of winning the lotto. If I won the lotto and I got $1 million and I had to pay $300,000 of income tax, I wouldn't say no to the other $700,000 I got to keep. I would just be smart and put aside $300,000 to make sure that I can cover my income tax liability. Same thing here. If I'm going to get a couple $100,000, sure, it might create $30,000, $40,000 of extra income tax liability. Be smart, make sure that you know ahead of time that you do need to take care of that income tax liability, but you're going to get that either part of your ERTC, and it will end up benefiting your company. And again, it's fully refundable. So it's an actual check that the IRS is sending to the business. So who's eligible for this? Okay, so I know that I've got this potential check that I can get from the IRS having to do with COVID related payroll that I paid during that time. So how can I become eligible? A few things, some bigger points in regards to 2020, and I'm going to split out 2020 versus 2021 because those are two different periods and are looked at differently. So as far as 2020, you had to have 100 or fewer average monthly full-time equivalent employees in 2019. So basically 100 or fewer employees to qualify for this program. And then you had to either have a fully or partially suspension of operations, explain what that means in a sec, or you had to have a decline in your gross receipts. So the decline in gross receipts is easier than the suspended operations. Basically, if your receipts were in any quarter of 2020 were less than 50% of the same quarter in 2019. So let's say quarter 2, 2020. If my total sales were less than 50% of the same quarter in 2019, a lot of us saw closures where we weren't able to do business. If I had one quarter that qualified that way, I will qualify for that quarter and continue to qualify until my receipts were over 80% of what it was in the prior year. So let's say quarter 2, I was at 40% in 2020 versus quarter 2 of 2019. I'll qualify for that quarter, and let's say I was at 75% for the rest of the year because I had restrictions in place that made it difficult to do business. I'm going to continue to qualify for the entirety of 2020. So that's the declining gross receipts way to qualify. That is not the only way to qualify, and I guess this is the biggest misconception that I hear that CPAs are telling business owners. you don't have to have a reduction in receipts or gross income to qualify for this program. The fully or partially suspension of operations is the way that most businesses qualify for that. And what that means is if your business had a capacity restriction, let's say you were at 50% capacity, most restaurants, gyms, retail, even here in Washington State, professional offices had a capacity restriction all the way through June 30th, 2021. Because of that, that caused us business owners to have to restructure the way that we were doing business, and that is a qualifying event. So if you restructured the way that you were doing business, you found out some way in order to send some people home to be able to work from home, but you had to take a period of doing that because of that government mandate, that will qualify you for that quarter. And as long as that government mandate was around, for the ERTC. And that's really the way that most businesses end up qualifying, because most businesses had some sort of government mandate. And again, it has to be a mandate. It can't be a suggestion. It does have to be COVID based. It can't be based off of something else. That is really what ends up qualifying a business owner for this. So if you don't qualify under the gross receipts test, you can qualify under this full or partial suspension test. So there are a couple different ways to qualify. So okay, let's say I qualify. Let's say I had capacity restrictions for 2020. A lot of us did, or other examples of ways that might qualify: government mandate that might have caused you to have to change your hours. Some social distancing mandates do apply. Disruption of supply chain, so not being able to get some of your product that you needed because of a government mandate. Those are all examples of full or partial suspension that would qualify. So let's say I did have something like that in 2020. How much then am I really looking at getting back? So the amount that I'm looking at is roughly 50% of my qualified wages. It has to be W-2 employees, cannot be 1099s. We get that question quite a bit. Can I qualify, independent contractors, monies that I paid to independent contractors? You can't. It has to be W-2 wages. It is wages paid after March 13th through 2020 until December 31st of 2020. And the maximum amount is $10,000 in wages per employee per year, which equates to roughly $5,000 of a credit per employee per year. So let's say I have qualification. I'm a hotel, and hotels that had restrictions in regards to capacity limitations, social distancing, qualified for the entirety of 2020. If I had 10 employees with that hotel, more than likely over the year of 2020, I paid those 10 employees more than $10,000. It's a pretty low threshold to achieve. Then I'm looking at a credit that I'm going to get back from the IRS just for 2020 of roughly $50,000. So $5,000 per employee times 10. And that's basically the amount in 2020 that I would qualify for, assuming that I do qualify and go through all the steps to make sure that I do qualify. Some examples of wages I can include. So myself, if I'm an owner of the business, a majority owner of the business, I'm not going to be able to include myself as an S corporation. And then another example of who wouldn't be able to be included: if I'm a majority owner of the business and have related employees, then those employees that are related to me by blood wouldn't be able to qualify. Sorry, by blood or in-laws wouldn't be able to qualify. Spouses typically can qualify. Cousins are another example that can qualify, but there are some exceptions of who can and can't qualify. And this is why I highly recommend, as you're going through this, if you find you are eligible to file for this, definitely make sure they're asking you these right questions. Related employees, how much percentage of ownership do you have of the business, to see if there are exclusions that need to happen, because there are certain steps that have to happen to calculate this correctly. And this is one of them. One other notation up here in parentheses, you'll see it says includes qualified health plan expenses. So if you have a group medical plan, you can include that group medical expenses in the qualification of what we have here. So it's not just wages that you're paying, but also medical, as long as it's a qualified group medical plan. So if it's a reimbursement for the employee's individual plan, that would not qualify. It has to be a group medical plan. All right, so as I mentioned, 2020 was 1 year. The way that ERTC was calculated in 2020 was done different than the way ERTC was calculated in 2021, and eligibility also changed for 2021. And that was that big change in the Consolidated Appropriations Act that happened at the end of 2020 that really beefed up this program, made it a much better program, much more desirable for businesses to take a look and see if they're eligible. So the eligibility changes It was extended through December 31st, 2021. Instead of having 100 full-time equivalent employees or less to qualify, they bumped that up to 500 qualified monthly full-time equivalent employees or less. So up to 500 employees in 2019, if you were underneath that threshold, you're going to qualify. This expanded this quite a bit. And in the example that I was giving before, you had one company that had 10 employees, got $50,000. Well, a company that has 200 employees might be looking at $1 million. It definitely changes the numbers quite a bit as we're talking about some of the larger companies when we expanded it into what this is. That way of qualifying in regards to gross receipts test and making sure that your sales went down a certain point versus 2019. In 2020, we had to have a 50% reduction. In 2021, you only had to have a 20% reduction. So you take any quarter in the first 3 quarters actually of 2021, you compare that to the same quarter in 2019. If your sales were down 20% versus that same quarter in 2019, you're going to qualify to get reimbursement for payroll in that quarter and the following quarter after that. So it was much easier to qualify. We come across business owners that didn't have restrictions in 2021, but strangely, their sales were down over a certain quarter and they just didn't realize it was down more than 20% in that quarter as compared to the same quarter in 2019. And they did qualify to have payroll reimbursement for both that quarter and the following quarter. So much easier to qualify under the gross receipts test. And then this was the other part that was added that I alluded to earlier, recovery startup businesses. Those are businesses that started after February 15, 2020. They did need to have less than $1 million in gross receipts. They will automatically qualify for the last 2 quarters, so the last half of 2021, to have payroll reimbursement in those 2 quarters. All right, this is the great part. How did the amount qualified? I used an example before of a hotel that qualified in 2020 that had 10 employees. And in that example, all 10 employees were paid more than $10,000. So $5,000 per employee times 10, $50,000 is how much they got back in 2020. Well, in 2021, the calculations changed quite a bit. So instead of it being 50% of the first 10,000 you paid per employee, it was increased to 70% of the first 10,000 you paid per employee. So up to $7,000 of reimbursement of payroll paid per employee. The biggest change really is this one, which is the $10,000 max salary is per employee, but it's per quarter instead of per year. So in that example, I had those 10 employees that were all paid more than $10,000. Well, let's say they were paid $40,000 a year. That's a pretty decent salary as far as it goes, and not out of the ordinary. So if those employees all were paid $40,000 a year, and I was eligible in 2021, instead of me looking at $50,000 for the entire year, I would be eligible for 70% per quarter, so $10,000 per quarter, so $7,000 per employee times 10 employees is $70,000. But that eligibility would be $70,000 in the first quarter, $70,000 in the second quarter, $70,000 in the third quarter, and if I'm a recovery startup business, $70,000 in the fourth quarter. That's $280,000 of payroll reimbursement. This is why this is being hailed as one of the largest tax credits in U.S. history, because of the implications of how large the numbers actually get. Now, don't get me wrong, very few clients get to qualify for all the quarters, like the example that I gave you. Most clients qualify for usually most of 2020, and then maybe the first 2 quarters of 2021. If you had some sort of restriction or qualified under the gross receipts test. But you'll see how quickly the numbers go up in 2021 when you talk about the threshold for how much payroll you can use resetting every quarter. And that's really what made this quite a bit of a larger amount in 2021 versus 2020. So again, max credit $7,000 per employee as compared to $5,000 per employee in 2020. And this is where I use that example. Really, the maximum credit for most business owners is $26,000 per employee. If you were a recovery startup business, you could potentially have that fourth quarter of 2021, which gets up to $33,000. That is one thing I'll hit on a little bit here. Some business owners got confused. At first, when this was created with the Consolidated Appropriations Act, this was eligible for business owners, all business owners that qualified to file for all of 2021. It wasn't until later that Congress came back and changed the program. It was last minute. It was really in that fourth quarter of 2021 that they changed that last quarter. and made it so only recovery startup businesses could file for that last quarter. So I get some business owners that are confused, thinking they could go out and file for that last quarter. Unless you were a recovery startup business, you're not going to be eligible to file for that last quarter of 2021. All right, so now that we went over eligibility, talked a little bit about qualifying factors and how the calculations worked and what potential is out there for how much tax credit you could be getting back. Let's talk about pitfalls. So why didn't I hear about this? I get this all the time. We've been doing this for 2.5 years. We were one of the first companies that were providing ERTC services. As I mentioned before, at first, one of the bigger issues is that CPAs don't specialize in payroll tax related fields. Therefore, most CPAs weren't filing for this. Same thing, bookkeepers who do specialize in payroll tax areas, they didn't understand complicated tax matters, and it created this hole of an area where there weren't a lot of providers out there providing the services to be able to do that. Thankfully, CPAs have educated themselves since then. However, the industry trend's going that unfortunately there are a lot of businesses out there providing these services that realized there weren't ways for business owners to get this amount of money to them, and started providing services in blanket form, meaning that I just went over a bunch of rules of how you qualify and why you wouldn't qualify for the fourth quarter 2021. There were a lot of companies initially that went out there and just started filing for businesses for every period, regardless of eligibility, which was obviously a big no-no to be able to do. And there were also business owners that went, hey, I can get $300,000. I don't mind paying maybe 15%, $45,000 to these guys, because I'm still looking at getting, the other 85% coming to me. Well, the problem with that is the services that they were creating from this, it doesn't take $45,000 worth of accounting services to do that. Our background being in the accounting world, we know how to price accounting services. So on our end, the way we do things is we charge a flat fee depending on how many periods you qualify for. That flat fee is a little higher if you have over 50 employees, because it takes more time to enter. But we chose a flat fee model rather than a percentage model, because knowing that what this is creating in the industry is basically this price gouging model that happened. And the IRS, if you actually Google ERTC warnings from the IRS, that is one thing that they tell business owners, is to not work with ERTC companies that are charging you a percentage of what you're getting back. That type of mentality, what it's doing is it's basically motivating the provider to overqualify businesses so that the provider gets paid more. And unfortunately, in the end, the liability really falls with the business owner. So it's up to you to do your due diligence and make sure that you're not going out and finding somebody who's doing this incorrectly for you, which is why it's good to do your research on the matter. That's where we talked about price gouging, contingency fee basis. That's when they charge a percentage of what you're getting back. It's not allowed by CPA firms. It's a little questionable here, and the only reason people have gotten away with it is because these are amended returns, and the rule there is a little gray. Our fees on that fixed fixed fee basis, when you take the total amount we've charged customers divided by the total amount we've gotten back from customers, it's less than 2% roughly of what we've charged. Businesses that are charging ERTC credit companies that are doing this are usually charging 10, 15, or 20% of what they're actually getting back for companies. So if you hear something like that, I highly recommend to steer away from that. You're looking for a company that typically can charge an hourly fee or a set fee like we do. Being audit proof. This is the important part that the IRS is trying to make sure that people understand. Not only are there certain steps you need to go through in regards to eligibility for this program, but also making sure that you're doing all the calculations right. When I talk about ownership percentages and related employees to owners, or making sure to get your PPP information, so that way we're not double dipping using payroll that you used for forgiveness of your PPP, using that same payroll for ERTC. We have to do the calculations and separate that. And so it's up to you as a business owner to make sure that the PPP information is provided, so that way they can do calculations to separate out what is actually eligible for ERTC. So when I talk about being audit proof, if you're getting done with your filing, making sure that you understand how you qualified specifically. So was it based off of a gross receipts test? Was it based off a partial shutdown? If it's based off a partial shutdown, what were the rules that actually qualified you? Do you have the actual stated rule that you could provide to the IRS on an audit that shows, yes, I had a capacity restriction. Here's the rule that actually shows that. making sure that those things are around, and eligible wages, eligible medical, how much was actually used to calculate your ERTC. All those should be part of what you have as a package, so that way you're audit proof. If you ever got audited by the IRS, you have the proof to show that you actually did qualify and the amounts that you actually qualified for. Other pitfall of ERTC, unfortunately, this was not like the PPP that was facilitated through the SBA. This is done through the IRS. And as we all know, the IRS is wonderful at taking their time on everything. We were just talking beforehand, Glenn and I, about the time frame that the IRS takes, and the fact that unfortunately not everybody is going to go through the same experience. The time frame that the IRS takes when they process these is about 4 to 8 months. Thankfully, it's going a lot quicker now than it was before. Initially, when this program came around, the IRS took some time to get up to speed with making sure that their agents understood what they were looking for. But because it is an amended return by law, every amended return requires an IRS agent to actually physically look at this. So there's no electronic filing method. There's no way for the IRS just to process these like they do your original 941s automatically. You actually have to go through an entire process. Nothing that you're doing, it's basically sitting around and waiting. And that is one of the unfortunate sides, is it takes a good 4 to 8 months before you actually get payments for this. Thankfully, and I'm very, very proud of this, we've been doing this 2.5 years. In that time frame, we've gotten very, very few complicated matters. The only ones that we've seen of people that haven't gotten their payments. This isn't an application process. The application process is done when your provider are doing services for you. So assuming that's all done right, when this is sent off, there's no approval process afterwards. There's nothing else you're waiting for. As far as getting funds, the only problems that we've seen are clients that already have a tax liability, so they already owe taxes to the IRS. The IRS will obviously hold those funds and apply it to the other balances that you owe first before they issue you a refund. And we've had, in the thousands and thousands of returns that we filed, we've had 2 audits, both successful audits. IRS reached out to them, one of them wanted proof of eligibility, which they already had the rule that they qualified under. And then the second audit was wanting a breakdown of eligible wages and eligible medical, and that's a report that we already provide. So they just sent them that, and both audits were successful out of thousands of these filed. I hear some people get a little bit overly paranoid about this, saying, oh my goodness, if I file for this, am I going to get audited? We literally have had 2 audits out of thousands of returns that we filed. So no, you're not automatically getting audited, but that doesn't preclude you from wanting to make sure to do your due diligence as a business owner and make sure that you're audit proof. As you do this, you do want to go through the right steps of everything that you're doing. And then the last part there, again, I can't emphasize this enough. There is a requirement by the business owner to come back and report that income in the period that it's initially claimed, so that it can be taxable. That's another warning the IRS says, is that there are businesses out there that are filing for this and not coming back and taking care of that last step. We don't provide services for that. Usually what we do is we tell them to get a hold of your CPA or income tax preparer. And if a CPA and income tax preparer now has definitely gone through this process of figuring out how to report this as taxable income, just make sure that if you do file for this, you make sure to let them know so that when you get the funds, I don't usually recommend doing anything before you get the funds. When you do get the funds, you do report it appropriately. And I do believe that's it. So we can definitely open this up to Q&A. I see a couple things that have come across in the chat, and if anybody wants to speak, let me stop sharing here. And Glenn, I'm not quite sure how you'd like to do this.
I think if anybody just wants to use the hand raise function, maybe if you want to respond to the chats first,
yeah,
Thomas, and then after that, anybody wants to raise their hand, and then we can just go in order.
Sure. We'll start with Mark's question. Just to be clear, as a single owner S Corp, the W-2 is not eligible, correct? That is correct. So as I said, majority owners are not eligible to claim their wages for the ERTC. So if you qualified based off a revenue reduction or off of capacity limitation or some sort of partial shutdown, if you were the only owner of the business, so that makes you a majority owner, 51% or more, your W-2 wages aren't included. There's some complicated factors, and I'll definitely say this is the reason why we always ask for how much ownership do you have? Are you related to any other owners? Are you related to any employees? We go through all those steps because we need to make sure that we get through some of the complicated matters. Technically, somebody could have less than 51% ownership and still be considered a majority owner based off of lots of different rules. And those are the rules that we actually go through there. So you are correct. Just that owner's wages and anybody related to that owner wouldn't be included as eligible wages for this. And then I see, please clarify under I think it's 2021 eligibility criteria, how the gross receipts are compared for 2021 versus 2020 versus 2019. So you're always comparing to 2019. It's just whether you're looking at the period of 2020, whether you qualify for 2020, you're going to compare those 2020 gross receipts to 2019. In 2021, you're going to compare 2021 to 2019. You're very rarely ever comparing 2021 to 2020. So again, the most important thing for you to know is to take a look at your gross receipts for 2020. If you were at less than 50% of your gross receipts for the same quarter in 2019, then you'll qualify for that quarter in 2020 and continue to qualify until your gross receipts were more than 80% of the same quarter in 2019. That one's a little confusing. And this is why we always what we do is we just ask our clients for the gross receipts for each quarter, and we actually do these calculations for them because it can be a little confusing. In 2021, when the rules changed, it was a 20% reduction in gross receipts compared to the same quarter in 2019. If you qualify, you're just automatically qualifying for that quarter and the following quarter. There's no, threshold that it gets to. Every quarter of 2020 and 2021 that you look at has to be qualified for one reason or another. So we actually have to go through all the quarters. A lot of times that's where the partial shutdown rules actually qualify businesses for more periods. In Washington State, professional office like us, we had capacity restrictions. We had to send people home. That capacity restriction was around all the way from March of 2020 until June of 2021. So that blanket qualified all of the periods in there. Anything after that, we had to qualify based off of a revenue reduction. And so that's usually why most business owners qualify under the partial shutdown rather than the gross receipts test. And I do see, so Bruce, you.
A question on that.
Yeah.
So if there was a bump in, or there was an increase in revenue from 2019 to 2020, and then decline by more than 50% in 2021, I'm just talking about annual at this time because I don't have the data points on every quarter.
So you do have to look at every quarter, unfortunately. So I'm guessing in 2021, if your gross receipts were less than 50% compared to 2019, then chances are you will have quarters in
compared to 2020, but compared to 2019, they were a little above 50%.
Yeah, and you always have to compare to 2019. So in 2020, you compare to 2019, and 2021, you compare to 2019 to qualify the quarter in that year. So you're always going to have to compare back to 2019. So if 2019 was pretty low for you, let's say you started in 2019, chances are you aren't going to qualify under the gross receipts test, but that doesn't stop you from qualifying under the mandates, looking at mandates to see if there was anything that qualified under the partial shutdown test. As far as if anybody actually, and I'll put in our little plug here, if anybody has questions about eligibility, they can go to our website, ertcfiling.com. They can give us a call. I think our number will be provided. We provide a free consultation to go through this with you. So typically we can tell by industry that you're in, jurisdiction, so which state, city, sometimes there's city rules that might qualify your business for where it's at. And then of course, whether you were in business and what periods you were in business for. Usually we can do that and we can tell you whether you'll qualify under some sort of mandate. So the partial shutdown verification, we can qualify there.
Do we have, sorry, one more question here. So do we have to have an active account with, let's say, a payroll company like ADP for right now, or?
Oh, you just have to have had payroll at the time. You have had to have W-2 wages. So as long as you had some wages, you were reporting it on a 941, whether you used ADP or any other payroll, if you were doing it correctly. So we do have to know what those wages are. So be able to pull up a payroll report. We do have to see your 941 to be able to file for the amended 941. If you got PPP, we need to know how much you got in PPP. And then we typically go through the qualifying kind of questions of, how many owners are there? What's the percentage of ownership? Is there anybody related to owners? Anything like that?
Well, we do have the payroll, we did have payroll wages in 2021, 2020, 2019. 2022, it dropped off completely, and we have not had payroll wages.
So
we
we're
don't
looking
have
at those
active
periods of 2021 and 2020. So as long as you had payroll in those periods, it would qualify.
Would you be able to help us with ADP as well?
Correct. Yes. So the only ones we can't file for are, it's very rare, but some business owners have a PEO, professional employer organization. And the reason why we can't file for them is because you actually have to file for your ERTC credit under your PEO. That's a very rare circumstance. Typically, if you had ADP or any other normal payroll processor, that's fine. We can take the 941 that they prepared for you and file an amended 941. And there's really nothing you have to communicate to them. The only thing you need to communicate is back to your income tax accountant to make
So
sure
we just have to get the 941s from them?
Yep.
Okay.
Pretty easy on there. So Bruce had a question. What are the deadlines to file? Great question. Actually, it was just recently clarified that the deadlines, which are typically 3 years from the original point of filing. So our first deadline actually would have been coming up here in July. The IRS actually considers that original date of filing to be April 15th of the next year, not the actual due date due to certain circumstances of how the rules qualify. So what that means is for 2020 payroll, you have until April 15th of 2024. For 2021 payroll, you have until April 15th of 2025. So yes, it is coming up here within a year that the program will start to fall off, and then within 2 years, this program will be done. You do still have time. The one thing I would warn business owners is that make sure that you are filing for this considerably ahead of that deadline. What you don't want to do is get in the circumstance, let's say it does take you 6 months to get this refund back. You don't want to file 3 months before that deadline and fall into that group that hasn't gotten paid for their credit, but the deadline's already gone past, even though they filed beforehand. Supposedly, it's based off of the postmark date of when you actually send in your forms, but I would hate to trust the IRS to do anything correctly. So chances are there could be complications if you sent it 3 months before the deadline, but they didn't process it in time, and then all of a sudden after the deadlines, they're trying to tell you, well, sorry, you didn't meet it, and then you're going to have to argue, yes, we did, because it was postmarked on this day. Something you don't want to get into, so I'd recommend filing it plenty ahead of time if you are going to file. Pete had a question: is income recognized in period constructively received? So I assume you're talking about maybe a cash basis versus an accrual basis for the income. Pete, did you want to clarify that question, or am I understanding that correctly?
Yeah, you were.
Yep.
But it was also that it basically is going to be whenever we receive the refund is going to be the taxable period in which we have to declare it.
No, that is not correct. You actually have to declare so that's a great question. Yes, to clarify that. So the actual ERTC, so it's not really income, it's reduction of expense. So you're reducing your payroll expense, which makes it a taxable event. You actually have to report it in the period that you initially paid that payroll. So 2020,
okay, so
2021.
Where I was really getting is, do I need to file an amended return? And the answer is yes.
Yes, correct. Yes,
okay.
that's the pain in the butt part about this. I really wish that the IRS, when they came out with that rule, because all of us accountants were waiting for them to clarify, hey, do we have to go back and amend prior income taxes, or do you have to file it on current income taxes? They came back and said you have to file it on prior income taxes. Being perfectly honest, talking about industry trends, I know a lot of CPAs that are filing it on current income taxes. I understand why they're doing it. They're basically saying, hey, this client, if they owe $100,000 more in 2020 versus $100,000 more this year, it's pretty much a wash. So in an audit, they're not necessarily, it's basically going to be $100,000 more that year, $100,000 less this year, and an auditor will basically say, okay, well, it's a wash. Still, I understand the reason why they do that, but it's still right to go back and amend those prior returns. That's the correct way to do it. But industry trends, I've seen a lot of CPAs that are just filing it in the current year, if I'm just being honest.
Thank you.
Yep. I think I qualify for $10,000 for 2022 employees. Partial shutdown. Is it worth using a firm to apply for this amount, flat fee, or is it possible to file for it myself? It is definitely possible for you to file yourself. I never recommend it. I'm going to be completely honest, because there are so many little tiny rules that go into this and to how this qualifies, and who is qualified and who isn't qualified, and the periods that you actually qualify for, just to make sure you qualify for all the periods. I have a really hard time, and this is coming from having 20 years of accounting experience. Really, my passion working with small business owners, making sure they're taken care of. There's very few circumstances where I recommend somebody trying to file for this for themselves. So our policy, well, and this is another industry trend. So that contingency fee pricing, the percentage of what business owners are getting back, I find, because a lot of providers out there are charging that way, what they're doing is a disservice to truly small businesses, ones that only have 2 employees. There's no reason for them to want to file for those smaller businesses because the credits those smaller businesses are getting back are smaller. So they set this threshold of 10 employees or more to qualify. That bugged me as the founder of this company, that smaller businesses, who are usually the ones that really need this, that went through a lot to get through COVID. That's why we came up with that fixed rate policy. And then we actually reduce that rate if a circumstance works out where a business owner only has 1 or 2 employees. We're never going to, yes, it's a flat rate, but we're never going to make it more than what it takes to actually justify you filing. So a worry about fees being too high and tax liability being too high, is it worth it? No, this is meant to help business owners, and that's why we as a company kind of took that policy of reducing rates for those really truly smaller businesses that just need help filing this as they go through. And I think that's all the written ones. If anybody has any other questions, I would be happy to answer those. Just, I think, raise a hand or speak up. Okay, otherwise I think we're good to go, Glenn.
Yeah, any last questions? Otherwise, thanks, Thomas. Really appreciate your time with us today. I put your website up there too. You mentioned it too, and I just put it in the chat if anybody wants to go. But perfect.
Awesome.
All right. Well, thanks everyone for attending. And again, this will be recorded, or it is recorded, and the link will be available here. I'm sure Katie will send it out in a little bit. So thanks again, everyone. Appreciate it. And thanks, Thomas.
Thank you.
Thank
Thanks,
you.
Thomas. That was great.